First of all, I would like to welcome everyone. I, on the behalf of Alumni Committee, warmly welcome our guests, Ms. Rachna Biyani, Senior Associate CPP Investments, Shri Karan Parmanandka, Director, Trikon Asset Management Limited, Professor Rajeev, Assistant Professor in the Operations and Quantitative Methods area at IIM Raipur, and our esteemed alumni for joining us today in the seventh chapter of Gyan Series. Being the sole knowledge partner of Youth 20 Summit 2023, IIM Raipur is conducting Youth 20 consultations this year at the campus. And because of the same, Professor Ram Kumar Kakani, Director, IIM Raipur, and Professor Rachana, Chairperson, Alumni Committee, won't be able to join us today for the session. But we have a short message from the director, sir, for our guests and our alumni present over here today. So let us watch the video and hear from him.
Fantastic, proud moment that our alumni is taking the benefit of having two people with a similar profile and managing their career as husband-wife. And I'm sure there is a lot to learn from their experiences out there. So firstly, I would like to take this opportunity to thank our friends, Ms. Rachna, Biyani, and Shri Karan Parmanandka for being for being part of this event of alumni, and their topic, asset management in Hong Kong, managing career and kid managing careers and kids. Okay, it fantastically captures the idea of work-life balance issues which most of us face. And in this world of information overload and loads of information quantity, etc., and wherein life is very terrific, I think it will be very, very interesting to listen to them. So I think our alumni friends, I hope to meet you again. And thanks a ton to Karan and Rachna, both of you, Karanji and Rachnaji. Thank you so much. Hope we have a fantastic time with you, and I look forward to personally inviting both of you to IIM Raipur as well. Thank you.
Now let me introduce Professor Rajeev. Sir is an assistant professor in the Operations and Quantitative Methods area at IIM Raipur. He is a PhD holder in Quantitative Methods and Operations Management from the Indian Institute of Management, Coimbatore. He has an industry experience in the area of consulting and financial operations. Now, I would like to working in the investment management industry. Skilled in financial services valuation, management consulting, financial analysis, and finance. Strong finance professional from chartered accountant focused in accountancy from ICAI. Ms. Rachna Biyani is also an MBA in finance from FMS, University of Delhi. She is currently a senior associate at CPP Investments, skilled in financial modeling, equity research, and financial restructuring. Now I would like to call upon Professor Rajeev to give a short message to the alumni and the guests. Over to you, sir.
Thank you, Neha. I hope I am audible.
Yes, sir.
Yes, sir. Great. So fortunately or unfortunately, we couldn't get our director live for today's session due to the ongoing G20 consultations happening in our campus. But yes, so as planned, our program will be conducted as scheduled. So I'll be handling this responsibility of delivering the speech on behalf of them. So thank you for attending the sessions today and welcome for the chief guest speakers of the day, Shri Karan Parmanandka ji and Rachna Biyani ji, and faculty of IIM Raipur and my dear alumni who are present today for the session. It gives me immense pleasure to welcome you all to the 7th session of Gyan Series. I wish to convey my gratitude to the alumni present here, that despite being a weekend, you were able to spare time for us. Your presence matters a lot. Thank you, and I hope to receive more participation in the coming months. We launched our new series exclusively for our alumni, where industry experts deliver short interactive lectures to the prestigious alumni of IIM Raipur. This takes place on the last Saturday of every month, which is the reason why we cannot reschedule it to another day because it's kind of fixed. We also had our alumni meets in Bangalore, Mumbai, and Delhi as part of our ongoing contact sessions with our alumni. And we had our first city meet in September in Bangalore. We also had our homecoming event in December at IIM Raipur this year. We also completed the election process for the BOG as well as different city chapters, namely Delhi, Mumbai, Pune, Bangalore, Hyderabad, Chennai, and all chapters were formed. And I sincerely thank you, thank our director, Professor Ram Kumar Kakani, for conceptualizing the idea of Gyan Series and guiding the team for the planning of the event. Without his consistent support, this event would not have reached the consummation today. A special thanks to the guest speakers as well who agreed to deliver the talk in such a short notice and with minimum communication. I thank you, sir and madam, for sparing your valuable time and addressing our alumni today. Thank you. Thank you.
Now I would invite Ms. Rachna and Karan to take over and begin with the session.
Thanks so much, Neha. Thanks so much, Professor Rajeev, and also Kakani sir, for inviting us here. Kakani sir, now I have known for 10 plus years. So yeah, it was a privilege to be able to assist him in anything that he requests. Neha, would it be possible to make me the host for a little while, because I have some slides which I can go through.
Just give me a second, sir.
So while that is getting done, I'll just so this is supposed to be a very freewheeling kind of a chat. I think the way we have thought about it is 10 minutes I'll speak about what I'm doing here in my hedge fund. Then 10 minutes probably Rachna can take to give an overview of the entire asset management space with a color on how it with a special focus basically on Hong Kong. And then we can talk about managing household responsibilities, though I'm not sure if we do a very good job of that. But yeah, Neha, can I share the screen now?
I think she is working on it.
Okay. So I can just start. I can start with my. Oh yeah, I see that. Just 1 second. Yeah.
Sir, I've asked them, so they are making you the host.
Can everyone see my screen? I think it's working now.
Yes, it's visible.
Yeah.
Okay, perfect. So yeah, so I'll begin. My name is Karan Parmanandka. I've been working in hedge funds for last 5 years. Before that, I was working again in the asset management industry, but on the sell side for 5 years. And I've come to that what everything means. Firstly, in terms of just hedge funds, there's a lot of mystique generally involved in this. But at the core, it is just about researching companies and then building a position in the company. And so in general, there are two types of asset management companies that you can think of. One is called long only. These are the companies which typically only buy stocks. So they buy and hold stock and they make money when the stock price goes up. And then secondly is the hedge funds. The name hedge funds is there because hedge funds typically both are called long short funds. So they buy the shares, but they also sell the shares short. Like basically, if I buy, let's say Hindustan Levers, and if I sell Titan, then I make money if Hindustan Levers goes up, and I make money when Titan goes down. So in that sense, I basically hedge my risk. Market keeps going down, then I because I make some money from Titan. So that is why it's called hedge fund. Yeah, over the years, it has hedge funds have. I think that is the strict definition. In practical terms, I think what happens is in practical terms, which happens is that hedge funds typically go in and out of stocks very fast because there is just, in case of a long only fund, it would, if it there would be 8 people looking at the Indian markets, then in hedge fund typically there would be one guy looking at India, one guy looking at China, one guy looking at Japan, one guy looking at US, and so forth. So in that sense, the knowledge, so we have a great breadth of knowledge, but little less shallow depth of knowledge, right? So like if a guy is on the long only side looking at Hindustan Lever, so he would know a lot about the stock than we would know, right? But we would basically pride ourselves on being very, very nimble. And because we have a breadth of experience, so we generally supposed to be not get biased about our views. So I just put in this funny slide which says like, which sort of just references that that how little we know about a lot of stocks that we research. And what typically tends to happen is that our work hours are long. A part of that is just because we are so nimble, so that we have to study a stock very quickly before, yeah, because we have to get in and out of that very quickly. So this is basically what I do. Again, as I said, I think Rachna will talk about more about the different building blocks so that you can get a frame of reference that where does hedge fund sits among various job profiles which are available. And if I just talk a little bit about my journey, then yeah, sorry, first this slide. So this is again, I think the our motivation for giving this talk was basically to give you some kind of reference about the Hong Kong markets. And so these are the typical salaries for Hong Kong. This has been sourced from a like recruiter who's in the finance industries. So just as you guys are planning your next career moves, and I'm sure that there is like pros and cons of everything, but these kind of things, I think it's difficult to get. So this is a good, I think, reference checks, and these are all amounts in 1000 HKD. And like HKD is like 1:10 to INR, so it's very easy to convert. So just to give you a like just to quickly make you understand this table. So for like hedge fund, if you look at the analyst bracket, so the salary ranges is 720,000 K to 12,000 K, which is basically in INR terms, roughly you can think about 72 lakhs to 1.2 CR. And this is how probably you can read the entire table. Yeah, and just in terms of I thought I'll just talk a little about my background. So I come from Calcutta, a very strictly Marwadi family. None of anyone in my family had chosen the study part. We all went to like everyone went into business, and that was my dream job also, to get into something like this. But then things kept happening, and from yeah, it's just I kept doing well in studies, and then very surprisingly I did well in CA and managed to crack ZAT I did my MBA from XLRI. It seems ages ago, 2008 to 2010. There is where I had met Professor Kakani, and I had worked in a few projects with him. And after that, I joined, like, one thing I realized, like now with the benefit of hindsight, is that while studying, we had very little knowledge of what exactly different fields do, right? I think even from the college seniors, we didn't get much great color, and it sort of like it just went from accident to accident where we landed up, rather than this being a very well thought of plan. So from from XLRI, I went to Nomura. There I was on the sell side. Sell side is basically, on the asset management side, there are two big groups. One is sell side, which recommends stocks to buy. And then there is a buy side, which actually buys the stocks. So I was initially on the sell side. I worked across Nomura, Macquarie, and Bank of America in my last job. This happened over a period of 6-7 years. And after that, I think I got married in 2017, and both Rachna and me, after that, sort of had a conscious decision that we wanted to move to a bigger region because liquidity is higher and there are more opportunities to do different kind of stuff. So again, everything has pros and cons, and it required a lot of effort to move from sell side to buy side, because that's quite a difficult jump. Now it's getting easier, but it was more difficult back in the day. And then for the last 5 years have been Hong Kong, Miss India in many things, but in many things it's okay. I don't regret the decision I made. The biggest thing I miss from India is this. Okay, yeah, this thing is the biggest thing I miss in India, in Hong Kong. And yeah, I would end my presentation here. In case you guys want to learn more about hedge funds, and if not, if you are just interested in reading, like if you like reading about finance, etc., then I would recommend you the books, the book More Money Than God. I think it's a great book. The title, it's a bit hyperbolic, but the book is quite good. Yes, that is from my side. I'll hand it over to Rachna for her background. And yeah.
Awesome. Thank you so much. Thank you so much, Professor Rajeev and Neha and IIM Raipur Alumni Committee, for giving us the opportunity to speak with all of you and, hopefully get to know a bit of your stories as well. So just a quick background on my side. After I did my postgraduate from FMS, I joined Deutsche Bank in their investment banking team in Mumbai. I was there for 2 years. Then I moved to Barclays Equity Research. Then Barclays was shutting their equities desk. So I moved to SSG, which is currently Eris SSG. SSG Capital, in case you're not aware, is a distressed assets company. And I'll get into that in a little bit. And 4 years ago, I moved to CPPIB, which is Canada Pension Plan Investment Board. So that's a quick summary of the companies that I went to, and I'm happy to go into details in case you guys want. Maybe as a first step, since I'm unaware of most of your backgrounds, as a first step, maybe I can talk through what asset management industry and asset management itself means. So very simply put, asset management is when you manage money, i.e. invest money. So first obvious question is, where does that money come from? That money can come from anywhere. It could be from retail investors, and therefore you could be a mutual fund, which is an asset manager. It could come from corporates. For example, you have extra surplus cash on your balance sheet and you'd like to invest that. It could come from pensioners, i.e. like CPPIB or Canada Pension Plan Investment Board invests the money of pensioners, Canadian pensioners. So it could come from pensioners. It could also come from savings of normal people like you and I. And that's how banks are able to lend money. So asset management is essentially when you have a pool of money and you asset manage it, i.e. you buy and sell it. Next question is, what do you buy and sell, right? So typically you could buy or sell on the liability side of any balance sheet of any company. On the liability side, you look at equity and you look at credit, and there are instruments in between. I can get into details like wherever you guys want. So maybe we can save the Q&A for later. But you can buy and sell equity, credit, and instruments in between. And these instruments can be either publicly listed or privately placed. And therefore, very broadly, if you were to oversimplify things, then there are public, private, and credit and equity. So you can either do public equity like Karan does in hedge fund. You can do public credit, which is buying and selling of bonds. You can do private equity or private debt. And in this, broad framework, you can think about all the asset management kind of comes into play. Again, there are people who do options trading, derivatives trading, FX trading, etc. So maybe for the sake of this conversation, I'm not going into the niche sectors, but if you just look from the broad market sizes, these are the 4 biggest dominant industries. Now in that, what I do is I do private credit and private debt. Now, how do asset managers get paid? Typically, it's a 2 and 20 structure, which means 2% of the pool of capital that they have, 2% of that is taken off as management fees. It doesn't go directly to you, to me. It actually goes into the GP or general company that manages this money, and then it gets allocated in many different ways. And 20%, so 2 and 20, 20% of the profits above a certain hurdle rate. That structure originally was always 2 and 20. Now it has started moving more towards 1.5/15, i.e. 1.5% of asset management fee and 15% of profit sharing above a certain hurdle. So that's broadly the incentive structure. I can get into what do I actually do in private credit and public credit. So again, every single field kind of opens up and you do multiple things. Like in private equity, you could technically do venture capital, etc. as well. So maybe just to keep life easy, I'll speak in broad brushes. In private credit, I do sponsor lev-fin or sponsor leverage finance. In very layman terms, what that means is that if a sponsor, i.e. let's say a private equity fund, wants to buy a company, then they want to look for financing. So to give a simple example, let's say Carlyle, which is one of the global private equity funds, wants to buy Hexaware, which is an IT company, then instead of putting the full $20 billion themselves, they might take $1 billion of financing from multiple different entities. And most people do that. For example, when Adani acquired Wholesome, they used this structure. When Blackstone acquired Emphasis, they use this structure, and so on and so forth. So financing typically forms a part of the acquisition. Why financing? Obviously, it reduces your own equity outflow and it juices up your returns because you're able to earn the equity return versus the fixed return that credit holds. So if you simply think about the, let's say, waterfall of how cash flows go, first person or first priority always goes to credit, second priority goes to equity. And because you get some kind of assured returns and assured downside protection, i.e. you can't lose, there is a higher likelihood that you will not lose that money. Therefore, credit requires less return. So in asset management industry, the entire concept is about pricing your risk. You do it in poker, I think we do it in life also, because the biggest asset that we have is time. So we think about the return that we get, i.e. spend it with our kids, and the risk that we do, which is I end up missing a deadline or something. So I think the whole game is about pricing the risk. So coming back to the same thing. So if, let's say, Carlyle were to acquire Hexaware, then they will take a financing. Now the obvious question is, why not ask a bank? They would ask a bank. But the way banks do credit is more a volume play rather than a individual deal play. So if Carlyle wants a bigger size, so banks would say, oh no, we can't give more than, let's say, $100 million, because more than that, you would cross our concentration limit risks. They could say, okay, how about we take 6 turns of leverage? 6 turns of leverage means if your EBITDA of a company is, let's say, 100, then 600 is the debt that you can take. So if Carlyle says, I want 6 turns of leverage, then the bank can say, no, we can only do, let's say, 2, 2.5, 3. So the point I'm trying to make is that banks typically do more volume, i.e. they want to do 20, 30, 40 transactions, and therefore their template of lending is much more standardized. So anytime a sponsor wants some specifications, they typically go to a private credit investor. Now, that's not to say banks don't come into play. So banks could very well be, so if you think of it again as a pyramid, then in the capital structure of the company that they want to buy, banks could sit at the very top, and therefore they are the least risky in the entire asset cap. And private credit would be somewhere in the middle, and below that would probably be equity. Let me know if I'm getting into too much detail, but I'm happy to like go up and down depending on how much you guys would like. So basically my role is to design and execute on those products that Carlyle might want. So Carlyle might say, okay, I need at least what they required at the time was $1 billion plus $250 million. So $1.25 billion of financing. So the easiest structure was, obviously, I don't want to give $1 billion either. So they launched a bond offering. So if you were to ever go on Bloomberg, then HEXWIN is the code for Hexaware bonds that are publicly traded. So they launched a $1 billion bond offering, and then they used a mezzanine structure, which is junior to the bond. So if you look at Hexaware's balance sheet, then on Hexaware's balance sheet, you will, like most IT companies, they generate a lot of cash flow. So they don't necessarily need a lot of debt. So this entire bond structure, as well as the mezzanine, is actually sitting one level above Hexaware, i.e. the entity through which Carlyle acquired Hexaware. So like, without getting into too much detail, again, I don't want to confuse anybody, but without getting into that, essentially my role is that if a sponsor or a private equity fund comes to us and says, okay, we want to buy this company, the kind of financing we'd like is this size. We don't want to pay cash coupon, so we'd like to pay the cash coupon later. We don't want to give amortization, i.e. pay down the principal in between. We would like to do that later. Like all the flexibilities that they require, we structure a document to allow for that to happen. And we say, okay, since we're meeting all of your flexibilities and all of your requirements, this is the price that I'd like you to pay me. And then there is this whole series of negotiation that they'll say, oh, this is too much, let's bring it down. And we say, no, this is what we need to have, and so on and so forth. So if I were to break down my role, it would be financial modeling. Financial modeling would be building down, the company's balance sheet, cash flow statement, income statement, etc. So take a look at the historical projections, project it into the future. Now, the way we look at company also differs depending on what you're doing. So if you're a credit investor, then you're much more downside protection focused because you can't lose your money. Like, for example, a private equity fund would make 20 investments. On 2 investments, they can make 100 times. On the others, they can lose their money and they're still fine. But a credit investor has to hit every single investment. At best, they can lose 1 investment, not all of them, because their returns will be wiped out. So the credit investor's view of looking at a company is to say, what is the worst that can happen? And will I still make my money? As long as that is done, then we can invest in the company. And the equity investor's return, on the other hand, is driven by the upside. Like what all needs to happen for the company to generate like upsized returns such that I end up making money. So the incentives, the lens in which you look at a company kind of differs, but the underlying work is probably the same, i.e. looking at a company, looking at their income statement, balance sheet, cash flow statement, and trying to crystal ball gaze what the future would look like. So that's one part of my job, financial modeling. Second part is preparing a memo. I think I never thought how important writing skills could be or communication skills could be, but it's ridiculously important, particularly in asset management industry. I'm sure it's true elsewhere as well, because so much of what we do is actually marketing and selling, our thought process, and communication skills helps you do that in the most effective, efficient manner. So the memos that we write and the presentation that we do has to be compelling enough such that weeks, months of research can get condensed into a easy to understand, digestible format so that our IC committee, i.e. investment committee, can go through that and make a judgment call. Does this investment make sense or not? So that's second part. And the third part is documentation. So like banks have a more standardized template as to, the things that you agree on between the counterparties. Whereas ours is a lot more, private credit is a lot more nuanced. So we end up getting into documentation, i.e. legal documentation, into individual components. So we had a handshake agreement that you don't want to pay cash. You want to pay PIK instrument, or the coupon every quarter or every year would get added and you'll pay it at the end of the year. So all of these things that we agreed on needs to be documented in the most proper manner in the legal document. And again, why this is extremely important is because, like, not so much in India, but globally, there have been many examples where the sponsor or the borrower would find loopholes and say, okay, no, this is what this means, and therefore we will not do that. So the language that you agree to has to be codified in a legal document. And again, it's a part of my job to make sure that the most important things that we focused on are getting captured in the document. And I obviously work, I'm not a lawyer, I work with lawyers to kind of make sure that happens. And the final stage is actually funding and then asset management. What that means is that through the life of the loan, I basically track the company, see how it's doing, whether it's tracking to my base case or not, whether I should change my assumptions, etc. Now, the difference between any private and any public company, be it equity debt, is that the public markets are on fire all the time. They can be affected by macro events, they can be affected by company events, and so on and so forth. And there is a real dissemination of information and a real up and down of share price, bond price, etc. In private credit, that is delayed somewhat, and there is a lot of discretion that I have about how I think about my given company. So in that sense, it's a little less stressful than a public entity, but again, that's something to think about. In terms of working hours, working days, it's more like during the days when we're live on a deal. Live deal means that it needs to be executed within the time frame. It could be anything from 12 to 14 hours every day, day after day, until the deal gets done. And then you take a break, you take a little bit of break, recharge, and then get back to work. On asset management days when we aren't going too strong or going too bullish on the market, then it's relatively easier. And then I just do, it's light, like maybe 4 hours, 5 hours. And because of after post-COVID, I can very easily work from home and, relax at home a bit and recharge until the next big project were to hit. So I'll maybe quickly touch up a little bit about what working in Hong Kong is actually like. In terms of practicalities, biggest practicality is obviously visa, working visa. I think Hong Kong is relatively easy versus other countries to get a working visa and figure out where and what and how you want to do it. I think it's much harder in Singapore, Australia, Canada, maybe a little bit easier, but I think Hong Kong is like very easy. I think anybody can come in and give it a try. The downsides are, it's obviously a very, very expensive city. Rent is extremely expensive. Groceries is very expensive, so on and so forth. In terms of the drawbacks, I'd say our language. I think Hong Kong earlier used to be a much more vibrant cosmopolitan city. Now is predominantly China-focused city. So I think you'll, at some point in time, if you want to live in Hong Kong for long term, you may want to think about learning the language. And there are two Chinese languages, Cantonese and Mandarin. Cantonese is more local Hong Kong, whereas Mandarin is more China Hong Kong. So maybe both, maybe a little bit of both, maybe just Mandarin. So we're kind of there. Like I'm trying to focus more on learning Mandarin just so I fit in a little bit more. Then last thing I'll probably touch on is food. We are vegetarian and my husband is still vegetarian. I've started becoming a bit more flexible because I've gone to umpteen of meetings and then realized that I can't eat boiled vegetables another time. So food can be an issue, particularly if you're outside of your usual. So my network is very, very diverse. There's no other Indian in my team. There's no other. It's hardly like maybe 1 or 2 other Indians and the 150 people in CPPIB in Hong Kong. So I think the whole concept of vegetarian is still a bit new and people are like, okay, you want vegetarian, here's a bowl of mushrooms, eat it. So it's a bit like that. So I've started becoming a bit more flexible about food. Again, that's something to think about when you think about moving to a new city. Networks, again, you have to be a lot more open-minded. Maybe in India, you'd be like, oh, these are my friends, these are my peers, and these are the people I interact with. When you come out, you have to be a lot more open to the idea of meeting people from completely new, different social circles, different walks of life, and figure out your path, figure out your circle. I'd say like networking in general is extremely important also because you change your careers a lot of times. Like I probably talked about mine, there are like 4 or 5 jobs that I've switched. I think it helps when you have friends too, because they tell you what to expect, what life is like, find out other new opportunities and so on and so forth. So I think networking in general, like being ready to make friends with people you're not necessarily want to make friends with, is just probably a good skill to have in any case. So maybe I'll take a pause here. And if there are any questions related to asset management, credit, hedge fund, equities, etc., like we're happy to field it. And then maybe we can get into the much more difficult topic of how to manage careers with kids or work-life balance. Should I maybe take a minute or two in case there are any questions? Like, please feel free to raise your hand. Otherwise, we can talk about how we look at our kids as well. or you can drop it in the chat box also. I think in case there's a little less hesitancy.
Yes, Swami, I see your hand raised. You can ask your question. Yeah.
You're on mute.
Yeah, first of all, congratulations to both of you, both couples managing asset management company. And my question is that we are a banker. I am in banking and on lending part, and we see the credit analysis based on long time horizons of 7 years in case of something infrastructure projects, in case of more than 10 years, 10 to 15 years. So in case of hedge fund, what is the time horizon, general time horizon?
For a hedge fund?
For a hedge fund, how
Yes.
much is the time horizon?
Okay. So Swami, there are two things, right? One is what we tell others and one what is actually there, right? So I think what we tell others is on the long side. So when you are buying a stock, typically one has a longer time horizon, right? So when we are buying a stock, then the time horizon we have is 2 to 3 years, right? Which is pretty standard. But when we are selling a stock, then there has to be a catalyst, because a stock can be expensive for a long period of time, and shorting has some costs, right? Because you are buying your derivatives, so you are paying someone, or you are buying a stock borrowing fee, which I don't want to get into details, but basically there's a cost. So in case of shorting, there has to be a catalyst that you have to know that within 6 months, this thing will play out. And why will it play out? Is it going to miss some earnings? Is there some extreme amount of competition which is coming in? Is the economy going to slow down? So just to give you an example, right now we were all over the Adani saga. Like I don't want to get into the merits or demerits of the case,
Yes.
both on the long side and the short side, because there was a lot of catalysts which are going on. Another example would be like if there's a rural slowdown, then there are some stocks like Imami, Dabur, Britannia, Gyan Irrigation. So these stocks will suffer if the monsoon is not good. So that was on the short side. On the long side, again, when I'm just thinking of recent examples, when Ambuja scaled down its ambitions, right? Because Adani was short of money. Yeah, so then there was scope for other cement companies like Ultratech, Dalmia Bharat, Shri Cement. If you look at their stock prices, they would have rallied, right? So like as an investor, you have to be careful to think that this has happened. Then first impact is very easy, but then you have to be cognizant of second order impacts, third order impacts. Okay, this has happened to Adani, then what will happen? Okay, Ambuja will scale down. Three, what will happen? Ultratech will have some breathing room, and everything happens very fast. So yeah, I gave a slightly long answer, but direct question.
One more thing is how much haircut you are going to take in case of exit. If your investment horizon is not achieved, then if you want to exit, then how much haircut? If there is any percentage in terms of how much percentage is that?
No, Swami, so there's no haircut sort of a formula. I think it depends on the individual investor. Like even in retail, you would see that some people buy stocks with a stop loss, and some people don't buy a stock with a stop loss. Hopefully, if you have like conviction in your so if you have conviction in what you have done, right? Like if you have bought Hindustan Lever and you have conviction in the share price and everything, then if it falls down, then typically you would buy more, right? You wouldn't actually have a stop loss. It's the other way around. Yeah, but that would, again, if the thesis has not changed, if something has happened, then you might change your thesis. But yeah, again, hedge funds would be typically more reactive. So like if the next quarter is going to be bad, then hedge fund might sell its stock, and a long only might say, doesn't matter, I'm going to hold this for the next 10 years. Next quarter can be bad, or everything else is okay. So yeah, so to answer your question, 2 to 3 years on the long side, 6 months on the short side, but typically, practically, I would say that on the long side also, 7-8 months, something or the other happens that we sell the stock. Either we book the gain or we book a loss. But yeah, that is the time horizon.
Okay, thank you.
So I like we are getting some questions on chat also. So probably we can take these one by one. I think one question is directly addressed to Rachna. I'll answer the first question, which is from PM, which is what are your typical hours for both of you? So I think Rachna described a little bit about her working hours, and I'll let her complete that answer. But for me, it gets a bit busy, more than I would ideally like. So again, there's more money, but like when we just started our career, like we guys used to have a very funny way of judging our careers, which is measurement was called ROTI, return on time invested. So I think ROTI for hedge funds is quite low because a lot of time gets into that. For me, typically, I try to reach office by 8:30, and like we have a 40-minute commute from home, which is typically longer than what people have in Hong Kong. People in Hong Kong generally have a 15 to 20-minute commute. They stay very close to their office. We have kids and wanted to have a certain lifestyle, so we have a 40-minute commute. So yeah, I reach office at 8:30, and I typically leave between 7:30 to 8. And then in the night, it depends. Like if there's earning calls, some companies releasing report, US is releasing some big data. So there might be some work, which is not often. And then on weekend, probably you can pencil in 3 to 4 hours. Yeah.
So my life is much easier. When I have like a live deal going on, then it's like I have a live deal going on right now. So for the last 4-5 days, I've been in office for 12 hours. And after that, I wasn't working. But I think I got done with it for most part. So I think next week will probably be easy, maybe 6-8 hours at work. And that's about it. And I generally don't work on weekends. So yeah, that's the working hours. I can move on to the next one, which says how vibrant is the Hong Kong VC ecosystem and how can one be a part of this ecosystem? It's a very interesting question. I think not just for Hong Kong, but for any VC ecosystem, you have to be a part of the circle of entrepreneurs itself and find your way into it. There are a couple of different ways to get into that ecosystem. One is if you're fortunate enough to have gone to one of those schools or colleges which produced or produces a lot of entrepreneurs, then it's easier to be a part of the VC ecosystem. But if not, then there are a lot of conferences and meetups, etc., that get organized where you can do it. I think the question is probably directed from the asset management side, and please let me know, Kunal, if that's not the case. From the asset management side, if you're saying you want to be a part of a VC investor in Hong Kong, that's possible, but I think Hong Kong VCs are more focused on China-focused entrepreneurs and funding their startups. So I think for a non-Chinese person to get into that would be a lot harder, but I don't think it's impossible. It just would require a lot more work. So language skills would definitely help. Being a part of that buddy system would kind of help. From the outside in, it is, I would say it's much harder. Like you'd have to work really hard to get into it. Let me know, Vicky, if that answered your question or if there's anything else. Oh, interesting. You can take the next one also from Vicky, which says, what's your assessment on Adani markets and refinancing? And you can touch on the LRS instructions in US currency. This is a live conversation right now. I think, don't think I can get into a lot of details because we are assessing it right now. So apologies, maybe I can talk to you on the side about this. I think it'll be a bit difficult for me to talk about it publicly. We're looking at it right now, so.
Yeah, just that this, yeah, so Adani, a lot of discussions are happening. And I think the short seller, again, we can't get into too much about this, but I think the short seller who has written the report has taken the short position through the bonds, because in India there's a restriction on how much you can short through the shares and who all can short. So I think the short seller has taken a position through the bonds. Yeah, but and there's like a lot of people, I see a lot of value in the bonds right now, especially for but yeah, it's just difficult to get into the uh, details if possible. No, it's not possible.
Yeah, sorry, 1 second.
And this LRS instructions in US currencies, sorry Vicky, so I didn't understand the question because like basically I'm not familiar with currency market or LRS so much. Can you just tell me more about the question, or maybe it doesn't does not fall within our expertise?
Hi, Vicky here. Can you hear me?
Yes, I can hear you, Vicky.
I'm just on the roadside, so thank you for having this discussion. No, just an instrument where the toll tracks and I am in the wealth management side.
Yes.
So how do you see the whole instrument which wants to have a exposure either in financial instrument or real estate to go and take this exposure of buying or selling that kind of opportunity. So something like having an asset overseas market. So that is something like I'm was looking to have some input from you.
Understood. I have like very little knowledge about this LRS instruments. I wouldn't go into that per se, but just in terms of overseas assets, I can just tell you that for our personal money, we have invested a lot in the US markets. I think what is very helpful in geographies like Hong Kong and Singapore is that there is no taxation on your other income, right? So like if you make any money from share gains, you make any money from interest, etc., then you don't pay tax, and you don't pay tax on US shares also, which is kind of very interesting, because if you are a US investor investing in US stocks, you pay a tax, but you don't pay tax if you are investing from Hong Kong. So because of just that tax arbitrage possibility which is there, most of our personal investments happen in overseas assets only. I think for the first year we sent some money to India investing in some Indian assets. But yeah, nowadays most of it happens outside India.
Next one is also for you.
Yeah, hi Vipur. Thanks for the question. So Vipur, so hedge funds, I think to switch, there's no hedge funds in India. Firstly, I think there's just one India focused hedge fund out of India, which is like Avendus as a product, but I don't know whether they are also very typical hedge fund. So if you have to switch to hedge fund, I think firstly you have to get yourself out. Like firstly, you have to think of having a career somewhere outside of India. Within Asia, Hong Kong is by far the biggest market for hedge fund. There is Singapore, which is coming up, and there's a lot of noise around it. But in just terms of quantum of money, yeah, Hong Kong is still the place to be. Typically, I think the way to go about is so. Okay, so I'll just tell you how we made it. So like for B, it was very quite organic. So the person I ended up working for, I used to service him on the sell side. So he was my client. So he liked the work and he called me. But for Rachna, I'll let her answer. Probably that is where your answer is.
Just coming back to the AIF category 2, hedge funds can set up as AIF categories too, but at the moment, I don't think a lot of hedge funds have set up as Cat 2 AIs yet. I think at the moment, hedge funds still, and also just after the current Adani saga, I think the government intention to allow shorting. So a hedge fund, in the sense that Karan has described it, long and short, shorting is extremely important. And just given the fact that a lot of geographies, and India in particular, is less keen on shorting, therefore, a hedge fund strategy working within India, it doesn't happen too much now, and it's hard to happen in future also, while legal wise, of course, through AIF Cat 2, it will be allowed to do. Also, I think the AIF Cat 2 is not allowed to take leverage. whereas a lot of funds end up taking leverage just to reduce their outflow. So that's on that side. If you think about hedge fund in a more broader sense, which is hedge fund, i.e. any place where you do non-traditional instruments. So my last place where I was, SSG Capital or Ares SSG, would be considered a hedge fund because it used to look at distressed investing. And in distressed investing, what we ended up doing was taking the full capital structure of a company, meaning everything from debt, equity, the entire liability side is essentially owned by us, and the promoter runs the company, and we kind of turn the switch as and when things are required. Entering into that is obviously possible, but from wealth management to getting into hedge fund, I think you're better positioned through equity research route. Like, that's not to say that there is no way, no how anybody from any space of life can get into hedge funds or like asset management broadly, but things that will improve your chances of getting selected is being available in that space and circulating in that space. So who are the individuals which professions are in that space? Lawyers are in that space. Equity research analysts, credit research analysts, or research analysts are in that space. Then, if you're a single investor, like another very non-traditional way is, if you're a single investor, you set up your Twitter account or YouTube account and you start giving your presentation on your non-traditional thought process, then also that attracts a lot of attention from different, funds, and they can give you a pod. Pod means here is let's say a 10 million or 10 million, 5 million, pot of money. If you can invest it and turn it into like good returns, then, maybe they give you a bigger seed pool of money. So I think at the moment, the earlier route was much more traditional. You do investment banking, or you do equity research, or you do lawyer or whatever, like one of the places that, are in the asset management orbit, and then you get into asset management. At the moment, I think there are lots of orbits. So all you need to think about broadly is how to get within that orbit of those people who do asset management, and then figure out how you can make a good impression and, get into that circle, if that's your ambition.
So now I would request all the participants who have further questions to directly connect to you through LinkedIn, because we are running short on time, and we have Y20 events like later on. So I guess we should wrap it up in another 5 minutes or so.
Sure.
Yeah.
Thank you so much, Neha, and thank you for organizing this. Maybe on the last part on managing kids, to be honest, we're still struggling. I don't think there is a right answer on, what's the best way. And of course, just given how challenging the careers are, it's harder to manage. What we try to do, and right now both our daughters are quite young, so maybe they need us a little less, but just going forward, I don't know if you have any particular answers. I think the best answer is probably to spend as much time as you possibly can, which means everything else for us, like our focus on our health, our personal goals, our own free time kind of reduces, because that goes directly to the kids, at least for me.
Yeah. No, so again, two things I would like to say. Firstly, from a Hong Kong perspective, what happens is that here, so there are many countries in the Western countries where you cannot hire a domestic help. And then there are some countries, which is Hong Kong, Singapore, Taiwan, the Middle East, where you can get very good domestic help. So I think that is like essential. Without that, zero possibility that both of us can be working, right? There's no great crash system. Because of COVID, our parents couldn't come, but even if they could have come, I'm not sure how much of managing they could have done. So that's one, that domestic helps are very important for us. We have two for our two kids, and they stay with us. They are like our family. But within the Western world, I think it's very challenging. And secondly, just you tend to be very, very efficient about things. Like the mantra we have is automate, social, like three things: A, automate; B, socialize; three, prioritize. A, automate as many things as we can. So like every week we have our menus, which is decided and stuck to the fridge, and our health knows how to make it, where to go, what to do. B is socialize, as Rachna earlier said, that networking is very important, and for our own sanity as well. Staying out of India, staying away from India, there are no family functions, no festivities, no nothing. So we have to you have to get uncomfortable in getting out and getting to know people. And three is to prioritize, just cut off everything, right? No going to Pathan movies, no watching popcorn in the movies and everything. So you have to practice, you have to make sure that you spend time with the kids and with the other things. Just the weekend we have, like, so yeah, it becomes very essential to very effectively manage your time.
I'm conscious that Neha wants us to stop talking as they have other things going on. So
Nothing of that sort. It's just that, like, because today Y20 is going on
no, I
specific.
understand, completely understand. So if there are any further questions, please feel free to reach out to us on LinkedIn. Happy to help, happy to connect. If you guys drop by in Hong Kong, then please come by, say hi. We'll take you out for coffee, drinks.
Yeah,
So it'll be good to meet a new set of people as well. So thank you so much, Neha. Thank you so much, Professor Rajeev, and thank you so much, Alumni Committee at IIM Raipur, for giving us the opportunity to speak to so many of you.
So now, on behalf of Alumni Committee, we are glad to express our vote of thanks. A very special thanks to our speakers, Ms. Rachna Biyani and Shri Karan Parmanandka, for accepting our invitation and for being here with us virtually, even despite their hectic schedule. Your thoughts and views on hedge funds, stocks, Hong Kong market, asset management, and your life at Hong Kong has given us new perspectives for sure. We thank our director, Professor Ram Kumar Kakani and Professor Rajeev for standing by us and making this event possible. Thanks to Professor Archana Parashar for ensuring everything went smoothly in advance, even when she could not make it to this chapter of the series. I would be failing in my duty if I did not thank our esteemed alumni for being here and making this event a wonderful and memorable one. Thank you once again.
Thanks, everyone.
Thanks for the session. So hope to see you in campus sometime when you visit India.
For sure,
sir.
For sure. Thank you. Thank you, sir.
Okay, thank you. Bye.
Thank you. Bye.